Let me say something that might sting a bit, but you need to hear it. Most people watching this video will work hard their entire lives, make what looks like good money, and still end up stressed, dependent, and quietly disappointed, not because they were lazy, not because they weren't smart, and not because they didn't want it bad enough. They lost because they followed advice that felt safe but wasn't. See, nobody teaches you how money actually works long term. You're taught how to earn it, how to spend it, how to survive, but not how to build wealth that doesn't collapse under pressure. And the most dangerous part? The worst financial decisions don't feel reckless. They feel responsible. Saving everything in cash, waiting for the right time to invest, jumping in and out of markets, buying things because I deserve it. It all sounds reasonable. Until 10 years passed and you suddenly realize you ran really fast in the wrong direction. Today I'm going to show you the safest way to build wealth long term. Not flashy, not exciting, but brutally effective. And fair warning, this strategy is boring. Like Swiss watch boring. No hype, no drama, just precision. Which is exactly why it works. Stay with me, because near the end I'll explain why what feels risky is often the safest move you can make, and what feels safe might be silently wrecking your future. Point 1. The biggest lie about safe money. Let's start with a simple question. What do most people call safe money? A savings account, holding cash, not investing because the market feels uncertain. Sounds sensible, right? Here's the uncomfortable truth. Cash is not safe. It just feels safe. Inflation doesn't show up with sirens. It doesn't send you a notification. It quietly erodes your purchasing power every single year. You don't notice it day to day, but zoom out 5, 10, 20 years. That safe money loses more than you think. Now don't misunderstand me. Emergency funds matter. Liquidity matters. Having cash gives you flexibility. But confusing comfort with safety is how people lose decades. Here's a pattern interrupt for you. If cash were truly safe, why do the wealthiest institutions on earth avoid holding too much of it? Banks invest. Pension funds invest. Endowments invest. Because the real risk isn't short-term volatility. The real risk is standing still while time keeps moving. The safest wealth strategy doesn't eliminate risk. It manages risk intelligently over time. And that brings us to the first real rule of long-term wealth. How real wealth actually compounds. Point 2. Play the longest game in the room. Here's the truth wealthy people understand early. Time beats talent. Time beats intelligence. Time even beats luck. The person who starts early and stays consistent will almost always beat the person who tries to be clever. This is where compounding becomes unfair. Money earning more money, stacking quietly in the background. But here's the part nobody warns you about. Compounding feels useless at first. The first year, nothing happens. The first 5 years, meh. The first 10, still underwhelming. This is where most people quit. They say things like, this isn't working. I could do better elsewhere. I'll start again later. But later is expensive. Because compounding doesn't grow in a straight line. It grows exponentially. Years 15 to 30 do more work than years 1 to 14 combined. That's why long-term investors look boring early and unstoppable later. This isn't about hustle. It's about patience with structure. So what exactly are they investing in? Point 3. Boring assets relentlessly. Here's where people get disappointed. There is no secret asset class, no whispered insider play, no bloke in a group chat with guaranteed returns. The foundation of long-term wealth is simple. Broad, diversified, low-cost investments. Total market index funds, global exposure, minimal fees, consistent contributions. Yeah, that, the stuff nobody flexes online. But here's why it works. You're not betting on one company. You're betting on human progress, innovation, productivity, growth over time. Markets go down, they panic, they crash, but zoom out far enough. And the long-term trend has always rewarded disciplined ownership. Not timing, not prediction. Ownership. This isn't exciting. It's reliable. and reliability over decades. That's lethal. But there's still a problem most people ignore. Point 4. Remove yourself from the decision. If your wealth plan depends on motivation, you're already in trouble. Motivation fades, life gets busy, emotions kick in. The safest system is the one that doesn't ask how you feel today. Automatic contributions, scheduled investments, no monthly debate. You don't decide to invest, it just happens. This is how people accidentally become wealthy. Not because they're special, but because they removed friction. Quick reality check. Would you trust future you with thousands of dollars after a bad breakup? During a market crash? After doom-scrolling finance Twitter? Exactly. Automation isn't lazy. It's intelligent humility. Point 5. The real risk everyone ignores. Most people think risk means volatility. Prices going up and down, red days, market drops. But volatility is temporary. The real risk? Not owning productive assets. Not letting your money participate in growth. Not compounding early enough. That's permanent damage. Playing it safe by avoiding markets often guarantees you lose purchasing power long term. The safest investors accept short-term discomfort for long-term certainty. Which brings us to the part nobody likes to hear. Point 6. You can't outinvest bad behavior. You can have the perfect portfolio and still fail because behavior beats strategy, panic selling, trend chasing, overchecking balances, reacting to headlines. The safest wealth builders do something radical. They do less. They check quarterly, not daily. They rebalance calmly. They ignore noise. They understand this one rule. The market transfers money from the impatient to the patient. Every crash is tuition. Every downturn is a test. Most people fail because they confuse discomfort with danger. Point 7. The psychology that makes this work. Let's zoom out. Why does this boring strategy actually win? Because it works with human nature, you're not against it. It accepts that. You'll feel fear, you'll doubt yourself, you'll want to quit. So it builds guardrails. Structure over emotion, systems over vibes, process over prediction. This isn't about being fearless, it's about being consistent. And consistency over decades, that's unstoppable. Why this builds a wealthy life, not just a big number. Point 8. Wealth is optionality. Let's be clear, the goal isn't money, the goal is options. The ability to walk away from bad jobs, say yes to better opportunities, slow down when life hits, speed up when it matters. Long-term wealth buys breathing room. It lets you live deliberately instead of reactively, and the safest strategy is the one that protects your future self from regret. Which leads to the final truth. Point 9. Your 30s will judge your 20s. If you're 18 to 30 right now, every dollar you invest today has absurd leverage. Your future self is watching quietly. They're either going to say, "Thank you for starting early," or, "Why didn't you take this seriously when it mattered?" Most people don't lose money in their 20s, they lose time. And time never comes back, so here's my ask. If this video made you pause, even a little, don't scroll. Because the next video on your screen is the uncomfortable sequel. Most people will regret how they handled money in their 30s. It connects directly to everything we talked about today, and shows what happens when people ignore this path. Click it now. Your future self, they're already hoping you do.